Well, good morning, folks. Today is the big day. CPI comes out and jobs at the same time, 8:30 a.m. Eastern Time. And I put up a couple of little tweets out last night, very late, just having a look at these numbers and what the market expects. So if you're interested in my Twitter channel, go across. It's ArcisFX, the handle at Twitter, and you can get all this stuff. I put it up every day. And there are two charts that I put up here. These are really interesting. And this is the first one going back to the 1970s on the CPI inflation. And this is the core CPI number. And you can see what happened in the 1970s. We got a sort of a peak inflation early on, actually late in the very late 60s. That was pretty similar to what we've got today. And I just wanted to point this out because it's interesting. Actually, this was right at the beginning, 1970 itself. We got this triple top, a peak inflation at around about 6 point something percent where we are right now. There's where we are today. And we got this sort of double top, and then we got a triple top. Right now we've got a double top. The question is, are we going to get a triple top? In other words, is inflation going to come down on this next reading today at 8:30 a.m. Eastern Time? And what happened was, as far as I can remember, and I think the chap's name was Volcker. I wasn't alive. Well, I was alive. I certainly wasn't trading the markets back then. But they began to cut interest rates prematurely, as far as I understand. I could be completely wrong. And inflation started to move down, and it didn't get down to this 2% level, which is the sort of norm, and it began to rocket. There were all sorts of other factors involved in the 70s, of course. And then it came down again, and then it rocketed all the way up to 12, 13, 14%. Now, the Fed doesn't want this to happen, of course. We've got a double top in place. Are we moving down? Is this reading going to be lower, or are we going to get another peak like we did then? I don't know. It doesn't really matter. The point is we're still a very long way from 2%, which is what the Fed has been very clear about is their target. There's another example of a double top, which we may be getting here. So the point is we don't know if this print today is going to be lower. Could be a triple top. Could be that we move back up above 6%, which would be disastrous for the markets. But even if it is a little bit lower than 6%, maybe 5.5, 5.3, something like that, we're still a very long way from the Fed target of 2%. So that's the first important thing to remember. The risk for the markets is downwards, not upwards, as most people seem to think. Now, if we have a look at what they want to try and prevent, which I've just illustrated to you, is this sort of thing from happening by prematurely easing up on rates, slowing down the rate hike rate, and also even potentially cutting rates. They're not going to do it. They don't want this to happen again. I projected this same pattern into the future from where we are today. They don't want this to happen like it did then, and so we're not going to see any dramatic easing of rates, any easing of rates at all. And the market is probably going to be surprised because Papa Powell is so friendly, so gentle, so kind, so sweet, and yet the words he says are really steely and flinty, and I don't think that's going to change. And I don't know what the inflation rate is going to be today, but remember, we've got to get down to 2%. We're a long way off. We don't want this sort of thing to happen, and there's potential for a little tick up today. No matter what happens, we're a long way from 2% and the risks to the downside. Let's see what happened to the markets yesterday. I'm actually going to start with stocks today. And you can see yesterday the markets all moved up. NASDAQ, S&P, US 30 all moved up quite nicely. We got roughly a 2% rally in mostly everything. And the key thing to take away from this is that the risk to the market is to the downside. We're at resistance levels. Let's have a look at the NASDAQ and the S&P. These are the most important ones. This is this level I was telling you about in the last video. I said we'd probably range between the red and the green line until the CPI number comes out. Now we've got a few hours to go, 5 hours or so to go before the number as I make this video. So, and we have been within this range. We're at the top side. We've got resistance. This moving average here is the 50-day moving average. The 100 is just above us. And this line here, this red line at around about what is it? 11,400 is an incredibly crucial and key number. We've got the 100-day moving average curling down. We've got the 50-day moving average that we're just tapping up against right now. And we've got this long-term supply and demand area at 11,400. So the strategy today is to actually not trade until the number comes out. We're not in the business of predicting what's going to happen. CPI might tick up, it might tick down. We might get a reaction one way or the other in the market, depending on the way it's interpreted in the overall picture of what I've just shown. I think the risk is to the downside. My strategy, if anything, will be to sell into rallies. We're going to wait for probably the best and the most likely scenario is we get a slight improvement in inflation. The market ticks up by 1% or 2%, and then we start to fade that move, and the market then begins to perhaps butt up against this 100-period moving average, 11,500, perhaps even 11,800, and then begin to move down from there going into the rest of this month. That's what I think. Same with the S&P 500. Well, this is even more clear, really. We've got this green trend line that we're pushing up against. We've got the 200-day moving average, which we just touched yesterday. We've got this long-term purple downtrend since the beginning of last year, and that's hovering above us with loads of ominous heaviness and weight, and we've got various resistance levels up above us. Yes, we are above the 50-day moving average. We are above the 100-day moving average, but same strategy. I think we could get a rally into 4,000, maybe slightly above 4,000. That would take us up to this green line, would take us above the 200 moving average, and that's actually pretty crucial. It would take us above the 200, but that doesn't make a bull trend. It simply means that it could be a bull trap. Above the 200 moving average is this downward trend line, and that's at around 4,010, 4,020 today. So I think rallies up into anything over 4,000, good areas to sell the Standard and Poor's 500 index. And I'm not going to look at any of these other ones. We saw a big rally in Amazon. What is interesting actually is Amazon, for example, and Apple. Let's just very briefly have a look at where they are in comparison to the whole picture. This is Amazon. We've rallied right up into resistance. We could get up into this gap. There's a big gap here at around 106. We're right now at 95. I think we probably try and get up to around about the 100 level, the start of this gap, or thereabouts into this area here. Don't think we're going to get much higher, but it's possible we could get up to this 100-day moving average, which is, again, at around 106 to 108. That's Amazon. And then, so I'm just looking at the big names on NASDAQ, and then Apple, which is the biggest one. We've got this level here that we've just moved into at 135-ish, that level there. Very key support double bottom over there. There's going to be a lot of argy-bargy happening there. And if we do move up to 135, 136 on Apple, that will take the NASDAQ up to that 11,400, 11,500, 600 area, which I've just pointed out to you. So these all line up pretty well. Big resistance overhead on Apple, Amazon, and all the rest of them on the NASDAQ, Microsoft, Google, whatever. And at the same time, we've got big resistance overhead. And I don't think that the market is going to be terribly excited by a small downtick in CPI. And perhaps we could even get a small uptick. Who knows? So sell into rallies. That's my strategy on there. Euro, we've still really done very little. We went short a couple of times yesterday, got stopped out 2 or 3 times for very small amounts, and we just edged up a little bit on Euro. But I think overall, this pattern might hold. We're still short the Euro. Our stops are above 1.08, and with a bit of luck, we'll actually begin to move down. We've got to break through this 1.0720 level. That's the key level. If I draw a horizontal line in there, you'll see why. And let's just put that one in. this level here. If we can get down below here, that will be super helpful for euro shorts. So that's at 1.0720. So we've got the support level there formed by the last 3 days, resistance over here and resistance over there. So we're short this. If we can get below there, that would be great. Again, all depends on CPI. I don't think we're going to be taking any new positions right now until CPI comes out. I'm not going to talk about any of the other majors because the euro really and the dollar index are going to set the trend. We could analyze all of these till the cows come home, but it's not going to make any difference whatsoever. The only thing that's going to change the direction of these currencies today is the inflation number. And don't forget, we've got jobs coming out at the same moment, 8:30 a.m. Eastern time. So these are the two biggest numbers, actually. Think about this. These are the two biggest numbers that the Fed is looking at the moment. Jobs and inflation. It's jobs and inflation. They want jobs down. They want inflation down. If we don't see jobs down, and we haven't been seeing jobs dropping off much, we've been seeing strong job numbers. So these two are going to work hand in hand, inflation and jobs. It's going to be a shift storm, as the latest meme is, of note, because we could get jobs up, inflation down, or jobs down, inflation up. We could get both of them not doing anything. We could get any combination of various factors, and then the market's going to decide what to do. So there's no point in analyzing all of this, except to say, may the best bet win, really. So that's why it's good not to be taking too many bets. I'm not going to be taking many bets into this going forward, into this number. Most of my trading today will be after the number. Here's Euro CAD. Again, we got stopped out once or twice yesterday. We did reach up to this top channel line, which again, I keep on reiterating, is a potential bullish flag. So what happens now is really important because we're just butting up right against there. We touched there yesterday, fell back. We've gone back there again today. If we have a look at the hourly chart, I see oil, so oil prices are rising. Oil prices had a good rally. We can have a look at oil. Let's quickly have a look at that while we're here. And so that continues to add some hope for, there was oil yesterday, so continues to add some hope for a stronger Canadian dollar, and hence a weaker Euro CAD, Euro Canadian dollar. That was oil yesterday. If I put the daily chart on here, Brent crude oil, big rally, and looks like we're forming a bottom on the oil price. We've just rallied up into this previous support. This level here that we're at right now is really key. If you're an oil trader, I think it's tricky. There were good opportunities to buy oil down here. This level here that we're at right this minute is, well, it's a tricky level. We're either going to get rejected there or we're going to move up through it. If we move through there, well, there's some hope for a continuation of the Euro Canadian dollar downwards. I'm just looking at this coincidentally. Now, that's that. Oil and Euro CAD, we're going to stick with those directions. And then the other Canadian dollar pairs, again, will pretty much follow suit. So we're just looking at Euro CAD. Now I've lost the ticker on this. Where has it gone? Is this the one? That's Euro Yen. And let's see, this is the difficulty because they all look pretty much the same when, there we go. So there's Euro CAD. And so we're at the top of this potential flag. Doesn't mean it is a flag, but it could be. But if we see oil begin to carry on higher, if we see this start to show some weakness, we're overbought on the hour chart. We've got this 20-day moving average, which if we fall back below it, we didn't close much above it yesterday, if at all, slightly. So if we can close beneath this 20-day moving average, you can see it acted as support all the way along here. Then it acted as resistance, potentially now resistance. If we can close beneath that 20 MA and then close beneath this lower channel line, then we should see a merry way on with EuroCAD. Now let's have a look at the yen crosses. These are the interesting ones. in terms of. So basically, as you saw, please watch my video yesterday. I'll put the link up to the end of this one. But there is every reason to believe that we'll see further strength in the Japanese yen. And we're starting to see that. The most interesting one, you can see they all curled down a little bit yesterday. Euro yen, New Zealand dollar yen, all just curling down a wee bit. And that's what we want to see. New Zealand dollar yen and Aussie yen are probably the most interesting. And this was our trade of the day yesterday, Aussie yen, and remains the same today. We're in good profit on this already. But here's the pattern. Go and have a look at yesterday's video again. There are also some tweets on this and some other YouTube stuff that I've put up. We want to see a move down below today's level. It's 90.8. And you can see if you go to the left-hand side where 90.8 is on this chart. Again, if I draw let's try and get this, let's move this level down to where we are, this line. So that's where we are right at the moment, this green line that I've just drawn in, 90.8, call it 90.75, 90 anywhere between 90.6 and 90.8. This line here is where we've fallen down to, really key support level. It's been resistance, it's been support over and over again. Well, 1, 2, call it 3, 4, 5. 5 times it's been really good support for the Australian dollar yen. And now we've got, just got to turn my phone off, excuse me. And now we've got a collapse back down to the same support. But we've got all this overhead resistance above us. So if we can get through that level, then we really should head back down to 87. And we should be on our way. Longer term target for this, apart from being 88, 87 there at the bottom, is probably down into the low 80s. So that'll be pretty good. That's still our trade of the day, trade of the week, potentially trade of the month. And we're pretty well into the profit on this and quite well positioned with a reasonable amount. So, and for the same reason, I'm not going to go into all the other yen crosses because they'll all be pretty similar. And then gold and silver and Dixie. Well, gold continues to edge higher. We've taken a few very small positions on here, shorting gold. They've mostly gone into profit. We took some profit, then we took another trade that took a little loss, then we took some profit and then a little loss. So we've been chopping around in this range, not making much progress. Probably square for the day yesterday on gold. Silver, we took some profit on silver, just selling at these highs. We're flat on silver. And again, all of this is going to depend a lot on CPI and the outlook for the dollar and the outlook for the markets. If the markets start to take on risk and people want to move into equities and out of the dollar, and they think that equities are going to yield something better than perhaps the dollar or gold, we could see a move, at least a short-term drop in gold. Overall, remember, I'm bullish on gold. I'm looking for opportunities to buy low down here, around 1800 down to 1750. But whether we'll get there right now or not, I don't know. All of these are very speculative and depend on what the market's going to do today. So I don't know. Dixie, once again, please, again, just have a look at yesterday's video because nothing's changed. If you haven't seen it, I'll put the link at the end. And we're just hovering around support right now. The risk for dollar index has moved down to closer to 100. If we can hold above this level here, which is a long-term support level, and the bottom of a very similar and friendly pattern, which we often trade, and that's this bugle. I'm going to call it a different name every time, but today it's going to be a bugle pattern, and or a foghorn. A megaphone sounds too scientific, really, somehow. I like bugle. There's sort of a trumpet call announcement of victory. So we'll call it a bugle today. If we can hold above the bottom of this downward descending bugle downward trend line, support line, we still have a chance of seeing the dollar rally up. But again, It's all in the hands of CPI and jobs later on, so there's no point in speculating too much. And the only other one that I can talk about is the pound South African rand. We bought on support here at the 100-day moving average, and so far, so good on pound South African rand. I always sell South African rands whenever I get the chance. There's no good news for South Africa, unfortunately, in the economy and electricity, infrastructure, you name it, squabbling, corruption, decaying of all sorts of services. 4 to 6 hours a day, every single day without electricity in an advanced economy can't be good. There's no way that I'd be buying rands. And good opportunities always exist to sell South African rands against the pound or the US dollar. Well, I hope you found that useful. Good luck for CPI today. I'm trying to keep these videos as short as possible, but there is a lot to go through. So I shall see you on the flip side. And so trade of the day, just a reminder, and luckily one that's not affected by the dollar relationship between dollar and other currencies, Australian dollar, Japanese yen. Good luck.